And even more excited to welcome Matt Rutherford here. So everyone want to start with a kind round of applause for Matt? Perfect. So I sent some analysts some information, a quick bio about you, Matt. But I wanted to see if you wanted to kick it off. Tell us a little bit about yourself and your current roles, kind of through the course of your career.
Sure. So hopefully you can hear me. But I graduated from college in 2001. I went straight into graduate school and did a public policy degree, a master's in public policy. And then from there went on to basically a career in government that lasted about 11 years. So I went to the New York Fed first, and there I was in the markets group, where it's basically the group that implements monetary policies of the FOMC in Washington, D.C., makes the decisions, and then kind of how monetary policy, the guts of monetary policy, how it actually flows through into the economy, is ultimately executed by the markets group in New York. So I was there basically until 2008, and then in 2008, I was sent down to the Treasury Department. My boss at the time said that there was no one at the Treasury Department, and this was in May 2008. So, you guys were very young, but Bear Stearns fell in March of 2008, and then kind of everyone was really on alert. Obviously, people were on alert prior to Bear Stearns, but it became sort of a five-alarm fire at that point, and so I was the lucky person who was sent down to Washington, and Hank Paulson was the Treasury Secretary, and there's a very close relationship between the New York Fed and the Treasury Department. The New York Fed is the fiscal agent of the Treasury Department, so it does a lot of work alongside the Treasury, and I was just lucky enough to be in sort of the right place at the right time because there was no one there to do work, and so I got thrown a lot of work when I was like 28 years old, 29 years old. And when I say there was no one there, I really mean there was like almost no one there. At the end of any administration, a lot of people leave early because think about, 3-4 months ago, a lot of people started to leave the Biden administration because everyone's competing for a limited pool of jobs and no one wants to wait till the last day to get a job. And so a lot of people started leaving about a year out. So the same thing happened in the end of the Bush administration. And in any event, I was there until the end of the Paulson time. And then when it was time to go back, Tim Geithner became the Treasury Secretary, and so he asked me to stay on, and then I was at the Treasury Department in the Obama administration from 2009 to 15, and I had a bunch of different roles there, mainly on the domestic side, but I had a bunch of exposure to some Harvard professors. Jeremy Stein's a good friend of mine, and we worked a lot with Larry Summers, and I don't know if you guys know Sam Hansen and Adi Sundaram, but both of those they're sort of my contemporaries. We all work together. So, and then Jeremy introduced me to Bracebridge Capital here in town in 2015. And so I got to know Nancy Zimmerman and Gabe Sunshine, and I came here in the fall of 2015, and it's been great. I run the developed market rates group, so we invest in kind of G4 currency, so dollars, euros, sterling, and yen. Sometimes we'll go a little bit further afield, but it's all relative value. And happy to go into that in any depth, but that's sort of, I guess, the last 23 years of my life.
Phenomenal. And can you explain a little bit about what your role looked like at the Treasury, specifically during the onset of the Great Financial Crisis? What was your responsibility? What was it like in the Treasury? And reflect on that.
The first thing that you realize is that the Treasury Department has no money. So they have a pot of money called the Exchange Stabilization Fund that's been used in different periods of stress. It was used during the Mexico, the crisis in 1994. It was used during the financial crisis, and then it was used actually during COVID as well. But it's like this $300 billion pot of money, and it's their only authority to used. It can only be used in defense of the US dollar. And so a lot of creativity, lawyer creativity goes into using it. But it's not like the Treasury Department can do fiscal policy. Congress does fiscal policy. And so when you have a financial crisis and the banks are having a hard time, there's a whole bunch of stages of grief on what the right thing to do was. And ultimately, just like any financial crisis, you ultimately have to get capital into the banking system. But there was no money to put into the banks in that moment. We were lucky enough in the summer of 2008, the GSEs, Fannie and Freddie, were having a hard time. Congress actually passed legislation because they were off-balance sheet government corporations, which was a whole other issue. But in terms of the structure, and it was sort of a messed up kind of contingent liability of the U.S. government. Congress actually passed legislation that allowed the Treasury to put equity into the GSEs. And so that solved that problem, but the banks were still an issue. And ultimately, the only way to do it was to get authority from Congress to put money in, and that was what TARP was, the Troubled Asset Relief Program, even though it was called the Troubled Asset Relief Program, because in the first moment, people thought that maybe we can just buy the bad loans off of banks, which is completely idiotic and was always going to be a loser, because the price that you would have to buy it off of the bank would be some discounted price, which would then lead to a hole in the balance sheet of the bank. There'd be an equity loss. You'd have to put equity in anyway. So it was always going to be a situation where you had to put in equity. But Treasury has no money. That's the first thing I realized. And you have to use the central bank balance sheet as creatively as possible, was probably the second thing. The central bank has an unlimited balance sheet. It can do whatever it wants. Obviously, I'm saying that sort of tongue-in-cheek, but the Fed can always print money and lend freely. And so in a crisis, the most important thing that can happen is that the fiscal authority, in this case the Treasury Department, has to work hand in glove with the monetary authority. And so I think at first I noticed that it was very contentious between the Fed and Treasury, and it was kind of what stage of grief are we in here? There was, you should do that, no, you should do that. And ultimately, none of it works until the moment where everyone joins hands and works together. And so I think the rule that ultimately we landed on, that has then been used all over the world, and actually again in 2020, is the Treasury is getting some money. That money can then be used as equity capital in a lending program that the central bank puts together and allows for the central bank to then use its balance sheet to lever that equity capital. So you can think of it this way, let's say there's a problem in a specific market, the corporate bond market, let's say. The Treasury could say, well, we have this money from Congress, we have $50 billion. We're going to put $50 billion into what we call a special purpose vehicle. That $50 billion is the first loss piece. If any losses come out of this program, that's going to come out of the Treasury's pocket. The Fed can then lend to that vehicle 10 times, 20 times over to create this massive program, because they have the balance sheet that can really expand. And so that was obviously a really important thing.
Awesome. Thank you for all the information. So I know you've mentioned previously that the government was not in an effective position to serve as a regulator in 2008. So what were your observations when you arrived at the Treasury, and how did this position as the government serving as a regulator change during your tenure there?
I think that the special interests over time create kind of a hodgepodge of a regulatory framework. So in 2008, the the regulators for the banks were the OCC, the SEC, the Fed, the OFAO was one, and there was one other. There was 5 different, some of these banks had 5 different regulators. It's insane. And so, no one had the full picture. And a lot of the banks were not what we called bank holding companies, which the Fed regulates. Okay, so you can think of, there's a bunch of different banks, right? There's kind of state chartered banks, there's nationally chartered banks, there's global banks. And so what was very obvious is that each of these regulators had their own, this is like classic, like, I'm holding on to this part of the bank, this is the most important thing, and I'm not going to share information with the other regulator. And so this is what happened with Bear Stearns. Like, Bear Stearns was a huge investment bank. They were regulated by the SEC. The SEC had no idea what was going on. The Fed was suddenly lending to Bear Stearns because if they didn't, they were worried it was going to go under. Fed couldn't get any information on what it was lending to because the SEC wouldn't give it to them. I mean, it was like mind-blowing. And so I think that what in the wake of all of that, we try to do is like really consolidate the regulatory architecture. And we were totally unsuccessful. It's like the SEC, the Fed, and the OCC still exist and regulate different parts of the banks. One good thing that did come out of it is that all the big banks became bank holding companies. And so the Fed is the regulator of the bank holding company, which is like the top co of any of these banks. So like if you think about JP Morgan, there's a holding company, and then there's an underneath it, there's an investment bank, there's a commercial bank, there's a wealth management arm. So the Fed regulates that top co thing, which does help with sort of streamlining a lot of it, but it doesn't solve all of it. And even regulating the holding company doesn't solve all the problems, because we saw a year ago right now, Silicon Valley Bank had a holding company and still ended up blowing up. So certainly we still have more work to do on that.
Perfect. And how did you see some of these lessons about what you learned in 2008 really employed during the COVID pandemic in the early days?
Okay, so number one, so there's fiscal policy and there's monetary policy. Fiscal policy, I think the lesson from 2008 to well, not everyone will agree with this, but I think it's not that controversial. Like from 2009 to 2013, we did this big stimulus in 2008 with TARP, and we sent checks to people. And then in 2009 and 10, everyone freaked out that the deficit was too big. So like almost overnight, the deficit went from 9% of GDP to 3% of GDP by 2012 or 2013 maybe. And we just had this like super slow recovery out of it. And a lot of people talk about how, coming out of a financial crisis, individuals, corporations have to repair their balance sheets. People refer to these things as like kind of balance sheet recessions, and that was certainly true. But I think that the consolidation of fiscal policy happening so rapidly was a disaster. And so it really kind of prolonged like this like economic malaise that we had. So I think the lesson that was learned out of that was like, once COVID hit, we have to like just go really big. Yeah. And obviously we went above and beyond anything that anyone thought was even plausible. The amount of money that went out the door was incredible. And so I would say that was one lesson, and we're sort of paying on some level, like there's this big debate around like, why did we have the inflation that we had? And there's like people who think we had this huge fiscal response. We sent money to people started saving it, and now they're spending it like crazy, and we're seeing the inflation aftermaths of that. And then there's another side of thinks that like the supply chains were really screwed up, et cetera. And so The truth is somewhere in between. But fiscal policy there. And then monetary policy, it was basically the exact same playbook. Every program that was employed in 2008 was basically dusted off the shelf and rolled back out. And every one of those programs was some variant on what I just described, which was the Treasury was given money during the COVID in 2020, COVID CARES package is what it was called. They were given like $450 billion of what was basically referred to as equity for Fed lending programs. And so the Fed then did everything. I mean, they were buying corporate bonds, they were buying commercial paper, and structured products, et cetera. I mean, it was basically everything under the sun. But all of it, again, is just some variant of Treasury equity, Fed leverage. And that seemed to be wildly successful. So.
Perfect. So it sounds like you were very busy at the Treasury from 2009 to 2015. But some of us in the crowd are really interested in, doing work in public sector and then maybe transitioning between industry and other fields after work in public sector. So what prompted your transition to Bracebridge? And do you have any advice for navigating a career between the private and public sector?
I think that, well, first of all, I sort of liked the idea I never thought of myself as just doing one, like I'd done public policy for over a decade, and I knew that wasn't going to be my permanent thing, and I loved it. I had like a great experience and saw a lot of really interesting things. But I always knew I wanted to do multiple things throughout my career and not have kind of like a one track thing. And so, I was always involved in markets throughout that entire time, just on the other side of the aisle, I guess. And so I always assumed at some point that I would go and try that. And so, in any event, I just always had it in the back of my head that I would go and do something different. And I think just in thinking about like people who are interested in public sector stuff, I mean, there's real like pros and cons associated with all of it. I mean, I think that there's few places in Washington that probably give young people as much responsibility as they do. I mean, there's a lot of young people who are just given lots of like runway to go do things. And I was a direct beneficiary of that, and like that happens all the time. That's the pro. The con is that it's very time, place, who we're working for centric, and a lot of it is luck, I think. And so I was really lucky who I was working with, but I think there's plenty of occasions where you would go down there and want to like bang your head against a wall. So just like anything, I mean, I think it's it really is sort of case specific, but certainly I got a lot out of it. I loved it, and just got to meet. I mean, certainly like some of the smartest people I've ever met in my life I was working with down there. Like, and I never felt like people there work 7 days a week, 24 hours a day. I mean, it is just nonstop. And so I never really ran into this idea of like bureaucrats who are doing nothing. I never really saw that.
Perfect. So in your current role at Bracebridge, you've had a career watching market players and investors exploit arbitrage opportunities to now finding those of your own. So do you think your extensive experience in the Fed and Treasury and watching the traders and markets really gave you this experience to become a better trader of your own rather than just say, going into trading immediately after?
I don't know. I mean, I think it gave me a nice knowledge background in terms of how to think about like certainly a lot of what we do is in the treasury market, especially right now, because the treasury market, our sovereign bond market is like pretty dislocated at the moment. Some of that has to do because of the way that the treasury issues bonds, and the Fed has stepped away and is not buying bonds anymore. In fact, is actually letting bonds roll off its balance sheet. But becoming a trader, I think is, that took a bit of time for me. Yeah. That was like a full retooling. I mean, I think that I was always, one of the things that I always thought was really important, that I learned a lot from my time in Washington, is, I don't know if any of you guys took debate, but like debate, like all we did in Washington was debate. So you'd like take an issue and you would debate it from like every single side. And that's what we did all day long. And I think that with trading, that's the way I sort of approached it at first. And that is good in some ways and bad in others. Because at some point you just have to make a decision and sort of move on. And so I really had to learn that. That took years, not months. I mean, I think everyone is still learning that as they go through their career.
Perfect. And you've mentioned a lot of similarities between the government's response to 2008 and 2020, using the lessons learned from the Great Financial Crisis. So, using your experience as a trader at Bracebridge, did you feel better prepared to kind of approach the markets, seeing the government's response to the COVID pandemic?
I mean, I felt like I understood exactly the playbook and how it would, what they would want to do or what they could do authority-wise. So I felt pretty confident in in sort of what they would do. The market response, though, was not something that, we had really ever seen before, because for a whole host of reasons, like the treasury market itself kind of imploded during this time frame. I mean, the treasury market is a place where people go and buy bonds when things are bad, and so yields typically fall when bad things are happening. But during that time frame, yields were rising rapidly for a bunch of reasons, but it was pretty alarming. And so, sure, I think I felt like I understood the basic technology of their programs, but the market response was like a whole different thing. And that was it was like a terrifying time frame. I mean, we were at work, and there was one night where we were like, is everything going to go bankrupt? Like, is there enough bankruptcy judges to process the wall of bankruptcies that's about to come down the pipeline? Obviously, this all was wrong, but it was pretty scary in that moment.
Perfect. And what night was that? Was that pretty early on in the pandemic, or was that April 2020? Or?
No, the worst week of that was the first 10 days of, I think it was the first 10 days of March. I think the Fed came in like sometime around now, 15 through 20. But until the Fed started coming in and buying bonds, it was total mayhem.
Wow, perfect. So glad that episode is over. But a lot of people now are, of course, talking about the upcoming 2024 election, a repeat of the election from 2020 with the same candidates. And so I was doing some reading into the stock market around elections, and seems to be a lot going on from the theory of presidential election cycles, that the stock market always performs better during the third year of a president's term, to some studies showing that a stock market traditionally performs better under Democratic administrations, or other studies do kind of the event study around the presidential election, of course, too. So really, if we were looking at the 2024 election through the lens and mindset of a trader, how are you thinking about this upcoming November? And is there any trends in the market that you're observing at the moment?
I'm exhausted by it. I think that, you tell me, am I supposed to take what Donald Trump's saying seriously? Because he's talking about somewhere between 10 and 60, or even in some cases 100% tariffs on imported goods. And I don't know. I mean, I think that seems like a big deal. And, you know, all of that kind of stuff, he can do all by himself without Congress, because there's this thing that he's using called Section 301 that basically is an executive order that allows him to just kind of play whack-a-mole. So, I mean, I don't know. This guy Lighthizer is apparently going to feature prominently, they say, in his second administration if he were to win. And I don't know. It seems like we should take him seriously. And that would be pretty hugely consequential, I think. So, a lot of it depends, though, on does he, if he wins, conditional on him winning, does he win the House and the Senate, or do the Republicans win the House and the Senate? And it seems like if he wins the presidential, it seems like that's totally plausible. And if he has both sides of Congress, you know, I mean, a lot can happen, and a lot will be unwound. And so I think it'll, you know, but if the Democrats win the House and he wins the presidency, I think the tariff thing will be the main kind of like economic issue that we'll be talking about.
Yes. So do a lot of hedge funds kind of look towards election night to see a lot of movement in the stock market? I believe that happened in 2016 after President Trump was elected. The stock market increased pretty dramatically over the coming months. So if you're kind of looking at the election night through the lens of a hedge fund, is it like, you know, you have plan A where Biden wins, or plan B where Trump wins, and then you have strategies accordingly?
I mean, I'm really hopeful that I don't have positions on that really matter whether he wins or not, but it's a fair question because, you know, like we trade relative value, and I think that, you know, there's within your portfolio, you're going to have positions that it might be a pure arbitrage, something that you know will close. You're long one thing, you're short another, but you know, that doesn't mean that the thing can't go haywire if the macro is going nuts. And so you always, even though we're in relative value, we have to keep an eye on this stuff because the dislocation itself can get much more dislocated in certain states of the world. So do hedge funds pay attention to this? Yeah, absolutely. I mean, they pay all the macro hedge funds pay private polling. I don't know why they do that, but it seems like a total waste of money. They did it during Brexit. In 2016, they did it in 2020, they'll do it again. They spend millions of dollars on like private polling when I don't know, there's like 100 polls we can go look at on the internet, but they do it and they'll do it again. It's not like a major it's so far away still. The place where you can see it the most is you can trade options on rates or on stocks. So you can think of like what we call implied vols. You can kind of see what the market's pricing in for November just based on the prices of those options. But it's just too early. People are talking about this. I don't think they're doing a lot of, you know, actual moving around of their portfolios yet. As we get closer, there'll be a lot of talk on the tariff stuff for sure.
And what is one thing you're looking at on the Biden side for a policy that you've mentioned the tariffs, and what else are you looking at?
I mean, I think it'll be, the biggest question is going to be the deficit and like, what does he want to do with that? I mean, we had a deficit of 6 to 6.5% of GDP last year when it was peacetime. I mean, these are massive numbers for a time period when the U.S. isn't at war or going through a financial crisis. So, you know, I think that Trump's not serious. Trump doesn't care about the deficit at all. So I think I have a pretty, I think anyone could pretty confidently say, I think, or have a decent bet on what will happen to rates if Trump wins, because he doesn't care at all. And I think Biden doesn't care that much either, but probably I think is a little bit more serious about it, even though we had a ridiculous deficit last year, so we'll see.
Perfect. All right, so I think we're going to open it up now to questions from the audience about anything about 2008 to the upcoming presidential election or vice versa. So Does anyone have any questions? Yep, I can bring the mic.
Well, yeah, we should, let me run the mic after I ask the question.
Hi, I'm Julian. I guess I just wanted to ask, like, one thing I've noticed is that, it's kind of hard for the Treasury Department and other government agencies and regulators to attract, like, the talent necessary to regulate these big banks because the banks, like, compete for the same people, and oftentimes people want, the high salaries. It's much more lucrative to work in the private sector. And so there's this kind of sense that the regulators are always playing catch up. And I'm wondering if you have thoughts, because you've been on both sides of this, on like how to perhaps correct that imbalance.
I think it's nearly impossible. So, I mean, obviously what you're saying is true. And I think that there's a couple of criticisms. One, they're always fighting the last war. And so actually Silicon Valley Bank is a great example of that. The Fed had been like so focused on making sure that the rules surrounding structured products, how much banks should hold against capital they should hold against structured products, et cetera, was appropriate. And there was like this pile of dynamite over here on like 4-year Treasury securities that they had basically told the banks, you need to hold more risk-free assets. And so, you push in one area, another problem pops up. And so that's a classic example to me of like just sort of like fighting the last war, like focusing on like the thing that happened in 2008. Meanwhile, the thing you are least worried about and the thing that actually you, in some ways, created. I mean, they didn't create total mismanagement of interest rate risk, but the Treasury security holdings were something that they basically told banks that they should do for various reasons. That's one thing. The other thing I think that that I think is true is just from a talent perspective, you can't keep up. It's impossible. And so to me, like, you can think about this in like the most simple way I can think about it is that we need to have these banks hold enough equity capital, have enough equity capital to withstand, severe stress. Because what we've done is we've tried to get a bunch of smart regulators, like the people who run the regulatory stuff are actually, they're smart. Like you would sit here, they could like walk you through exactly how they're thinking about things, and logically you'd be like, okay, that all makes sense to me. But it's really hard to stay on top of these banks. They're huge. Like the regulatory agencies don't have like the number of like the resources and number of people to follow all this stuff. And so rather than having like a rules-based regime, like a very strict rules-based regime where you have like, you need to have this amount on this thing, and just have them hold tons of equity. And so it's the easiest thing, and it's the most effective way for them to not blow up. So I think the counter to that is that equity capital is expensive. The banks will stand up and say, well, that's crazy, because you're going to reduce lending to the economy because equity capital is expensive. If you're going to make me hold more equity capital, I can only lend so much into the economy. So you get into this like conversation around like, okay, well, what's the cost of a financial crisis? And then like this cost benefit analysis just kind of goes down a rabbit hole of like, it's hard to like figure out, there's no right answer here. But so I would say that the second part of my answer would be, just force them to hold more equity. You're going to have to figure out, I would be worried about lending and like banks' ability to lend, but like it's simple, doesn't require, thousands of people like going through and trying to figure out, the various rules that they've put in place and make sure that they're complying with them, so.
Hi, I'm sorry if this question is a bit global, but Japan is the largest holder of U.S. treasuries in the world, essentially
big news today out of Japan with them finally exiting negative interest rates, and kind of the prospect of falling U.S. interest rates as well has sort of implications on the differential. I'm just wondering, how are you guys at Bracebridge thinking about what's happening over there and potential implications for the U.S. Treasury market?
When I started my career, Japan and China were the biggest holders of treasuries. And I'm going to get the numbers wrong, but, 50% of the treasury market was foreign owned. And a pretty substantial part of that was China and Japan. And so they made up like a big percentage of the holders of outstanding debt. You fast forward to today, neither of those portfolios have moved that much, but the treasury market itself has grown by $18 trillion. So like in 2011, I think there was like $12 trillion outstanding. Now I think there's over 30. And so their percentage holdings has gone down a lot. So this idea that like China could somehow, has us over a barrel is just nonsense. Your question about Japan is a good one, because I feel like throughout my career, I have noticed that whatever starts in Japan propagates throughout the entire world. And the reason for that, and this is sort of like a comment on East Asia generally, is that these markets, so Taiwan is another good example, they are huge exporters of capital, and they have huge savings, and they don't have enough financial instruments, basically, to recycle their savings back into their home market. So, again, I'm going to get the numbers wrong here, but I think that Taiwan, they own something like 30 or 40% of all U.S. investment grade credit longer than like 5 years. So they like own everything. And so when Japan starts to actually move, which they did overnight, so before the policy rate range was 0 to -10, they moved it to 0 plus 10, which sounds very small, but it's very exciting because they've been negative for a while. And the more rates in Japan go up, the more likely that we're going to have really big capital flows. So to the extent that Japanese government bond yields start to rise, it's more attractive for a Japanese investor to bring their money home. So take it out of the treasury market, take it out of the French government bond market, take it out of the U.S. investment grade credit market, and reinvest it in the JGB market. It just has like a pretty big impact on sort of like capital flows. So this was the first step. I mean, they telegraphed it well in advance, and who knows how far they will go. I mean, their debt to GDP is something like 250 or 260% or something like that. So I think there's a limit to how far the central bank can go, probably without causing the government an actual problem. But I think it's a big deal.
How effective do you think the injecting equity into the banks was in 2008?
Hugely effective. Yeah, I mean, I think it's the only thing that sort of solved the problem. So anytime a financial crisis happens, I think it's really about the uncertainty of the asset side of a bank balance sheet. Usually it starts with the banks, because they're kind of the central, if you think about like a hub and spoke system within the financial system, they're the center of it. And anytime that there is a problem, it usually is just, what is the value of that thing? Usually, not always, that thing is going to be a big asset class like housing. It can be, in emerging markets, it can be sovereign debt. Because a lot of emerging markets have their banking systems have big holdings of their local government bond markets. But in developed markets, it's usually going to be housing, because it's a big component of what banks do. The only way, you could never, it's too hard, it's too complicated to devise programs where you buy the assets and try to find a clearing price to give people certainty about what the value of that asset is. And as I was mentioning before, you might not like the value of that asset, and it will lead to a big capital loss elsewhere. So I think the only way to actually increase confidence and stem the tide is to shove equity capital in and give people confidence that they will not, that the banks are solvent, basically. And then, they can all, and the Fed can lend as much as they want against it. I think that the most interesting question, and this is really like about, was something that a lot of people focused on last year, is like, what is the right way to think about what we as a society decide is money and what deposits are worth? What should the government actually do in terms of providing deposit insurance? Last year after Silicon Valley, we effectively guaranteed the entire deposit base of the United States. They didn't say that, they didn't do it explicitly, but they might as well have, and people got that message. But that's a whole interesting, I think, thing that also happened in 2008 as well.
So you talked a little bit earlier about how we should think about regulating banks by increasing capital requirements. One of the things on the horizon is Basel III Endgame, and that's going to have significant impacts on capital ratios. And banks are having a pretty unprecedented reaction to this. You're seeing billboards about how this is going to hurt everyday Americans. They're starting to think about litigation against the government, which is, very, very significant. So I'm curious how you think about these significant regulations and how we can actually get them to occur given huge backlash from the banking system.
Yeah, you're right. I mean, they really organized and pushed back hard. Jay Powell 2 weeks ago basically said we're going to take another look at this entire thing because I think that the banks pushed back and said this is really going to be super onerous. My comment about equity capital was when I was answering your question around how to think about kind of regulating the banks in a world where you can't really keep up with them. My comment about equity capital was a generic one. I wasn't saying it should be 15, not 14. It was just the easiest thing to do and the safest thing to do is because it's just a vanilla thing that just makes everything safer and doesn't require, having a rules-based approach where every single thing needs to be kind of verified along the way that they were complying on the regulatory front. I don't really know what to make of the bank's complaints, to be honest with you. The banks that we deal with, I think before the financial crisis, the banks were really big players in the markets that I travel in. They were taking risk. They had big balance sheets that were taking principal risk in the financial instruments that we were trading. They're nothing now. I mean, they just are pretty much just, they're not principals, they're agents. You're a hedge fund, this is JP Morgan, you sell it to them, they sell it to me, and they don't have any sort of skin in the game. So ship is sort of sailed on that for financial markets. It's actually good for people like me in terms of our business model. I'm sort of skeptical that credit availability is not ample at the moment, but these are hugely complicated things. You can't model the cost benefits of moving equity capital up 100 basis points and how it's going to flow through the economy. I don't you could give me 10 studies and we could talk about it, but I wouldn't have any confidence in any of it. It's really hard. It's really hard.
Any other questions?
Hello. I have a question turning back to the 2008 financial crisis. You briefly mentioned the TARP program and also the Fed's lending to Bear Stearns, which led me to be interested in how you viewed the Lehman Brothers situation. The decision to not bail out Lehman Brothers was, as I understand it, quite controversial at the time and still debated today. So I was wondering if you could maybe discuss how you saw that situation unfold and whether you think, with hindsight, the Fed and the Treasury made the right decisions regarding that institution.
This was before the Lehman Brothers thing, was before TARP was passed. And so that was sort of like whack-a-mole time period where, Treasury didn't have any real money and the Fed was just trying to put out fires with its balance sheet, but was worried it was encroaching on fiscal policy, and so there was a lot of concern about that. I remember one morning, the weekend of, it was Friday of Lehman Brothers fell on a Sunday night. That Friday morning, I saw the chief of staff to the Treasury Secretary coming down the stairs, and he said both Barack Obama and John McCain, who's running for president on the Republican ticket, had called that morning and said, don't bail out Lehman Brothers. And so, that's all you really need to know. The political pressure to not bail out Lehman Brothers was enormous. No one was going to stick their neck out. And, it took that maybe to kind of clean up the mess with passing TARP, and it was a disaster. That was a horrible, I understand why they made the decision, but it was awful, and a lot of people suffered massively. A lot of people were thrown out of, not Lehman Brothers employees, but the U.S. economy. A lot of people were thrown out of work because of this. And so I think it would be hard to, aside from shutting down my kids' elementary schools during COVID, I can't think of a much worse public policy decision than that one, even though I understand why it happened exactly. And the people involved, I think, were really high-quality actors who were doing their best, but, oh man, it was awful.
Transitioning from the public to the private sector, in what ways you had advantage over other people who've never been in the public sector, and in what ways you had to adapt to the private reality?
I don't think I have much of an advantage. I would put it me just having to retool myself and adapt. I'm not betting on the direction of what the Fed is going to do or not. So it's not like I'm calling down to the Fed and talking to people who I know and trying to understand. I don't do any of that. I probably have some human capital from that time frame that I'm not articulating or even appreciating. But I would put it more towards I had to this was a new exciting thing. It was fun. It's fun learning new things. Why would I keep doing the same thing forever? And so it took me, we're always learning, but it was a hard transition, and it took me a few years, and I was lucky enough to have a boss and a group of people that I worked with that sort of, taught me about kind of how things work and how to think about running a portfolio and constructing a portfolio, and thinking about how to deal with sort of market stress, which is a very real thing, much different than any sort of stress that I was dealing with in Washington, because you feel it sort of at least the first time you really things go poorly, which inevitably they always will at some point. You just have to be sort of dispassionate and not take it on board it as, oh my God, I'm an idiot. What have I done? But that takes time. That's hard. And so that's not something that happens overnight.
How are we doing on time, Henry?
Yeah, we could probably take one more question if anyone has one.
I have one if no one else does. I was wondering how, if at all, you see AI being used either, at participants in the financial market like Bracebridge or on the government side in policy making or regulation.
I think, at Bracebridge, we have some people we have 3 or 4 people who are, working on machine learning and everything from like reading a prospectus for a specific financial instrument to thinking about prepayment speeds in some of the mortgage pools that we own. I haven't found like a really good way of using it in the stuff that I do. Most of the stuff that I've asked it just spits out nonsense. And like, I'll give you an example. Like, I'll feed it a bunch of stuff and then say like, can you summarize for me how people are positioned in this way? And it just sends back complete nonsense, useless. And then I was like, okay, well maybe we could use it for, bond market's like pretty antiquated in the following sense. Like in the morning, we get lists of like treasury securities that each dealer wants to buy or sell. And we're like, okay, well let's feed that into it and allow us to like collate it at least and like just make our lives a little bit easier. And then, of course, like Bloomberg was like, you can't do that. That's our data. So anyways, it's a long way of saying like, it will be useful replacing people who are writing code, I think. But in terms of like picking bonds and helping like a portfolio manager, like in a real sense, I don't think we're quite there. I don't know about government. I really don't know. I'd be terrified if I were government. Do you guys take, you take Jeremy's class, right? Do you? Okay, nice. Is it good?
Yeah, we talked about TARP yesterday.
Oh, you did?
And we kind of discussed the whole thing of buying the assets from them is really difficult, better to just, exactly what you basically said.
You did exactly mine about 5 years, so this is what I do from the beginning.
This is so stupid. I mean, yeah, I know. I encourage you to take Jeremy. I'm sure I would love to take Jeremy's class.
It's a great class.
We're also discussing like the interest rate spike in March 2020.
Oh yeah, that was awful.
From the 9th to the 16th, what caused it, I guess?
Wait, was it the 9th through the 16th?
Yeah.
Oh, well, okay, so wait, so you know this better than I do. I thought it was like the 1st through the 10th. There were 3 things that happened. Well, one was, this was the episode that I was talking about where, really strange things were happening in the treasury market. Usually rates fall when bad things happen, but rates were rising. The first was that everything seized up, so the only thing that was actually sellable, I think, was treasuries, and so people were just selling treasuries in mass. It was terrifying. Like, stocks would be limit down, treasury yields would be like 40 basis points higher. Like, I mean, it was just things that we'd never seen before. So I think it was like kind of raising cash mode and sell what you could. And then the second thing was that Nancy and I were on with JP Morgan and Morgan Stanley and Goldman. And there's this thing, there's a classic relative value trade where there's a treasury futures contract that people buy and sell, and it's based off of it's a quarterly contract where there's a bond that is cheapest to deliver into the contract, and people trade what they call the basis. So they trade the bond versus the futures contract, and they can get a little bit untethered at times, and so you can either buy or sell the bond and do the opposite on the future. So what happened was all these banks got really afraid that there was like 3 or 4 hedge funds that had a massive position in this, where they were long the bond and short the future, and they started calling all of them and telling them, we're going to pull your repo, which is the way that they finance the bond. And so then they just dumped everything into the market. So I think that was a part of it as well. But yeah, that was a mess.
Is there like an international?
No, not really. No. There was an international component in 2008. The Russians and Chinese were trying to get together and sell treasuries to hurt the U.S. in July and August. But no, there was it's ridiculous. But no, there wasn't much of an. I don't remember there being one. Maybe there was, but did Jeremy say there was? I don't.
I think like Annette Jorgensen paper that like summarized this said that there was like some like foreign central banks needed cash, so they were selling those treasuries.
Oh, yes, of course. Yes. There was, and so what the Fed did was they had, so dollar was doing what it does during that time period, and a lot of foreign central banks needed to defend their currencies. So they take the dollars and sell them and buy their currencies. And so you can see it in the Fed data where every foreign central bank, most foreign central banks custody their treasuries at the New York Fed. So there's like $3 trillion of treasuries at the New York Fed, and every Wednesday they release the data that shows how much treasuries are there. And I'm sure in the Jorgensen paper it shows that those went down, and that was to defend their currencies. And so the Fed actually put together a program where they basically said, don't sell your treasuries. We'll take them as collateral and give you cash. We'll do a repo with you so that you don't have to fire sale treasuries into that's the third thing. You're totally right.
Oh, they didn't talk about that like exchange thing.
Yeah, they put together a repo. It's called the Foreign Central Bank Repo Line.
Perfect. Well, thank you so much.
Yeah.
Everyone give Matt a round of applause.
Yeah.
And, we'll all stick around for a few minutes if anyone has any more questions for Matt, but thank you. Thank you so much. Famous. I see it's it's about guys. Alright, people, we're taking a photo with Matt at the front.
Okay,
Yeah.
that's cool.
So these other classes, like a second big class.
Oh, really?
Maybe
That's
if we
what's
could
always-
come out a little bit, we're gonna take a photo with everyone.
It was okay.
Alright, come on, guys.
Like this better?
Thank you.
Alright, let's move a little wider.
Wait, say it again.
Shorter people at the front, Matt at the center, it's not that complicated.
Because that's a whole lot. Yes, exactly, they had a lack of dollars, and so they needed dollars.
Alright, let's swap spots.
Yeah.
Okay.
Swap.
Alright. Ben, can you see everyone?
I'm awkward.
Okay. Maybe to back up a little?
Yeah, or I can do 0.5.
Okay.
I'll let you guys. Can you guys on the sides just move
Yeah.
Squat down a little bit.
Yeah, just go. Okay, great. Cool.
Thanks so much.
Thank you.
Thank you.
Yeah.
Wonderful.
Yeah. So they had a bunch of dollars.
Yeah.
And then there was a dollar funding squeeze. And
Because they were trying to lend to their banks to kind of thing.
so every European bank started buying dollar-denominated debt. They had lots of mortgage-backed, like CLOs and mortgage-backed securities. So then they had a lot of dollars. They didn't have access to the commercial paper market.
Because they on the flip off.
So you just think about it as like, you know. Okay, it's based in dollars. They need to fund it, so someone's got to lend them dollars. They don't have a deposit base.
No, because that's.
And so